Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on there? It's October 23rd. And I'm Frank Curzio, the Wall Street Unplugged podcast. We break down the headlines and tell you what's really moving these markets. Bring in the best-looking, best analyst in the world, Daniel Creech. How's it going, man?
Thought you were talking about somebody else there, Frank. Things are going good. Happy Wednesday, everybody.
Happy Wednesday. How was your weekend? How's everything?
It was good. It was a good time on the weekend. It's been beautiful since the storms. I mean, it's been absolutely paradise. When people think of Florida, they think of this weather we've been having, not the reality of bugs and Tyrannosauruses and all that kind of stuff that you have down here.
Yeah, it's nice. It gets down to like 60 and the high is like 75 and stuff like that.
But there was a cool car show on the island and a lot of old cars, new cars too, but mostly older school muscle cars and things. So I walked around down there and saw some things. It was pretty neat to see all that. A lot of cool stuff. I wonder if anybody's going to remodel or refurbish a Tesla in 20 or 30 years.
Maybe 20 years.
Maybe.
We'll see.
Like you see a lot of these old 65, 70 core, whatever cars. It's amazing. So.
No, definitely. I mean,
how was your weekend, Frank?
I thought you'd never ask. Thank you, Daniel. I actually had a really good weekend. My wife wasn't in town.
Batching it.
That's not why. But I'm just joking. But she actually went to go see a mom. As you guys know, mom's not doing too well. And she took my daughter with her, my oldest daughter, who went to go see a Billie Eilish concert in Madison Square Garden, which she loved. Which, by the way, was packed and they had no merch.
Who?
Billie Eilish. Just pretend that you know because
Eilish.
Eilish. Yeah.
Okay.
Just say, oh yeah, because she's like massive, but it's not my thing either. But yeah. So anyway, she enjoyed it. The merch was almost sold out, which is selling shirts and they call it merch now, which is so weird. I get used to like the new terms. We're getting old now. It's merchandise. It's merch. You sound cooler as an old dad. But while they were away, I spent a lot of time with my youngest daughter, which is really cool. So I drove down to Tampa. We went to Howl Scream at Busch Gardens.
Okay.
So it's like the same thing as the Halloween thing that they have in Orlando at where's Universal, and it was good. It was really good. Like it was scary. They had these haunted houses. You
went to Tampa or Orlando?
The one in Tampa.
The one in Tampa.
It was really, really good. We had a great time, and my daughter was screaming like crazy. We went on roller coasters at night. It's open till 1 a.m. She just didn't want to leave, so I went on like 4 or 5 roller coasters. She went on one roller coaster 3 times. So not bad. I told her, I try to pound in the head with, even though she doesn't care, that I'm 52. I don't see a lot of 52 here. I was going on roller coasters, so we had a lot of fun. It was nice. And I also got the chance to see my mom in the Villages, which was really cool. So I stopped by. I haven't seen her in probably like 2 months. So I was looking forward to seeing her. And that place, Daniel, the Villages, if you retire, even if you're single, go there. If you're not single, I mean, they got it going on there.
They do.
They really
heard
do.
Nothing but crazy good about
that.
I
mean, it was remarkable just to see. Every night they have a band playing outside. They have places that you could, they have outside drinks, drinking outside. They have every restaurant's packed. They're playing a Thunderstruck.
Nice.
Thunderstruck and it's set up. Everyone's happy. They're dancing. I actually took videos of it just to show my wife because it's amazing, like just how happy they are and how life's supposed to be when you retire. And if you don't do anything, it's because you don't want to do anything. They have anything that you want to do. You start clubs for. You celebrate everybody's birthday month, and everybody goes out to dinner, and it's just. It's a remarkable place. So they all have these, golf carts. It's like a golf cart community where everyone drives around. It's massive, by the way. And the golf carts, some of these are like really souped up. Like, they look amazing. Like just like really old fancy cars and stuff like that. So a lot of people, they'll get drunk at night and then drive and crash these things, which is just, it's just so much fun, right? They just have so much fun. It's
what's wild about that? One family owns all that?
What's wild about it? Now that the one family owns it is that they set it up where, I'm not going to say hurricane proof, but they have all the electricity in their lines going underground. They have just flood zones where they'll put on the sprinklers because they recycle the water for the lakes, where they'll drain them out. So this way, when it rains, it goes into the lakes and stuff like that. It's just, it's amazing because outside of the wind and stuff, you never have to worry about flooding. You never have to worry. Sometimes your electricity may go out, but a lot of this stuff is underground. It's very well done, and it's massive golf courses everywhere. It's really cool to see it because what happens when you get older? empty nester, your kids go away and sometimes you're sitting in the same house that maybe you own forever. And just to see all these people just having such a good time and friends and, they have places set up where if you're sick, it's okay. It's comfortable. It's just, some people just wheelchairs or whatever. It's just, it's really awesome. But I could tell you that every single thing that we did, it was packed. The park was packed, and man, did they charge a freaking fortune for that. Everything. They make you go on rides, and they're like, "Oh, you can't bring your bag. You got to go into the locker. You got to put in your locker. Okay, $4." I'm like, for an hour. It's they just make sure, like they have Chick-fil-A there, which they charge instead of getting a meal, they charge individually. It was $11 for the sandwich, $8 for the fries, $6, $7 for the Coke.
Oh, the
right?
a la carte.
It's everything. They just, they pull it out of you, man. And it was jammed. It was just amazing that even the week before that I saw with the economy, we go to this local fair, the Callahan Fair, which is, they have rides and stuff like that. It get packed and like $40, I think, $50 for a bracelet. And just, you hear stories about the economy not doing good. And even when I went to Vancouver, it was crazy. I mean, it was a little dead because it's the mining industry, which is weird, even though gold, silver, we'll talk about that in a minute. But went out with a couple of people, and at a restaurant on Tuesday, we couldn't get a reservation on a Tuesday until 8:30 at night. I mean, packed every table. I'm like, holy shit. It's weird what I'm seeing. I like to say this. I like to hear what you're seeing because look, a lot of people are struggling out there and we hear how bad the economy is, but everywhere you look, and what we're going to talk about today, even with some of these companies reporting earnings, they're reporting that things are pretty good. So, let's get into that now because, man, it's not just the companies. It's this rush, I think, Daniel, that when you're looking at Polymarket, which we talked about, Trump is really kicking ass in that poll. And that seems to be the poll everyone's looking at. He's going to win more than 60%, 61, 62%. And you're seeing a shift into certain stocks that benefit from his and sectors that benefit from his presidency. So now you're seeing a big focus on everything going on with politics and stuff like that, which, I guess we'll start there. Everybody loves when we talk about politics. So I guess we could start there and filter in because there's a lot of companies that reported and a lot of stuff going on, including billionaires, on CNBC, making bold comments, telling you their positions, which is pretty crazy. But man, it's heating up with 2 weeks left of the election. And I think the latest news I heard is Trump's going on Joe Rogan's podcast on Friday, and Harris hasn't decided yet if she's going. I think she should go, but that's going to be interesting because very, very big audience, and I'm looking forward to seeing it because. Hopefully Joe Rogan doesn't hold back because I like him. But just you're seeing this last 2 weeks, and it's going to get really dirty as well. So it's kind of crazy.
Yeah, it's definitely the blitz here. I don't watch a whole lot of TV, so I get spared from some of the commercials. That doesn't save me from when I'm in the car commuting and such. And when you watch live sports, of course, they're going to really ramp up the ads. Excuse me. But Polymarket, we talked a little bit about this last week. It's only gone more in favor of Trump. And remember, this isn't the gospel here, so don't take this too crazy. But there is over $2.3 billion in volume on these. Trump has a 64-36 lead on that. And you have seen this narrative of, these financial media guys and the billionaires are saying, hey, the market is acting like Trump's going to win the election. So the market and Polymarket here are kind of leaning towards Trump. And you see gold at record highs. You see Bitcoin making a push near its record highs. Yeah, it's down a little bit. And certain Trump stocks. And that's interesting because you have to balance that between, and every morning, I'm checking CNN, MSNBC, Yahoo Finance, Bloomberg, USA Today, blah, 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 blah. And all of those are pointing towards Harris being in a huge
she's up by 2-3%.
2-3%. But then there's so much more than that. And I feel like the media is trained there. There's no question who the media wants as a candidate and as the president. That's fine. Everybody has their opinions. But, I've seen this Yahoo article or somebody that's saying that in the younger generation, Harris has a 20-point advantage. Now, when you dig down, it was only a survey of 1,000 people. Mm-hmm. And so you have to kind of take that with some salt, just like this Polymarket case. There's $2 billion in volume, but that doesn't mean that they're, I like that people are betting on it, but you just got to take everything with some salt. And then you get into these, the fun headlines. So Jamie Dimon has been thrown around as a cabinet member and possibly a Trump thing. He's denied that, and they said this. Now, supposedly, according to headlines, he's supporting Kamala privately. He seems like he's supported Trump publicly in a few statements and all that stuff back into Davos. But yeah, this is what makes a market. You have two tails. One's going to be right. And we have 2 weeks from yesterday, right? Is when the election kicks off. So
yeah. And you said Trump did the McDonald's thing, which is funny because hopefully he didn't give anyone quarter pounders with E. coli, right? They just came out with McDonald's. Stock's not down too much. And McDonald's is going to definitely do the right thing on that. I don't think it relates to stocks, but, big deal.
Yeah.
For some people. But, and it's just amazing how you could see the same story in a video and how two stations have totally different opinion on it. Right?
Yeah.
It's just like,
if anybody, did you really think that was just a random thing? I mean, those things have got to be staged. The guy's been attempted to be assassinated twice. You don't think they're going to close down the McDonald's? Somebody was like, can you imagine somebody's reaction when they pull up President Trump? It's like, oh, there's nobody that went there.
No, the crowd that was there beforehand, of course. It's just, listen, it is politics and stuff. But what I like on CNBC is they're having some of the billionaires on. I think the other day they had Mark Cuban on, who was just, I thought he again, I'm Trump. I'm a Republican. You guys know that. It's not that if whoever wins, I'm going to support him, America first. But I felt like, he was really pushing against, Joe was the host and I felt like Joe didn't have a lot of comeback. So he was just like, Harris, pushing for Harris and stuff like that and all these policies and stuff, which is weird because he's really pushing out of nowhere, right? And I feel like when you look at Elon Musk on the other side, I felt like he got pushed to go to Trump. I don't know. I don't know with Cuban. It's just weird. Someone that I follow him for a long time, for him to come out like just the past 2 weeks, I feel like I said this joking around. I don't know if they got him at a Diddy party or something like that. But man, it's pretty crazy. But then they had today Andrew Sorkin was drilling. Who was it?
Bill Ackman.
Bill Ackman was on, and he was like going off on him. Like he was just, how can you support Trump? He pressed about Trump lying about illegal immigrants eating cats. And
Sorkin was pressing Ackman.
Sorkin was pressing Ackman, right?
Gotcha.
So he's talking about something about a deer. I didn't even hear about it that he lied about. And he's saying, well, this person says he's a fascist, he's Hitler, he's a racist. And I'm looking at that and I'm just, listening to it going, wow. And he represents like New York Times, Democrats, left. I get it, and I have no problem with that. You could support whoever you want, but the Democrats just don't fucking get it. It's not a character debate, right? You have both candidates that lack character in certain ways. I think most Republicans would agree, even with Trump, and come on, what are you saying that for? So it's not. This is not a character debate. Okay, this is about the economy. It's about the border. It's about America being safe, no wars, less taxes, low inflation. Those are a lot of the key issues here. Issues that Americans saw when he was president 4 years ago, and when Harris is pressed on these issues, she doesn't give any substance. And we're seeing that. Even the Democrats are saying that too. They're like, she's got to talk more and give more substance because every time they ask her about something, she's like, well, Trump is this and Trump is that. Trump was in office for the past 4 years. Okay. You act like he's been in office and all this stuff happened. So, it is interesting to see, but I will say one thing about Ackman because he said something that I think, because if you're a Democrat or Republican, you listen to this, you're not going to change your vote no matter what. There's some undecideds, right? Which is key and it's important. He said, forget about Trump and Harris and look at their teams. So you have Trump and then you have J.D. Vance. And J.D. Vance, capable of being president, everyone started starting to debate, listen to him on the campaign trail, very, very sharp, comes, the background, everything is there. They have Elon Musk, you have JFK Jr., you have Tulsi Gabbard, you have Vivek, and then you have, on Harris's side, you have Waltz. And he goes, this was a self-complained knucklehead, right? Which was a really bad to say. That was the first time I really listened to him, and I was like, he didn't seem like a bad guy. But he was like, after that, who do you have? Who do you have? So if you're looking at the biggest supporters, it seem like these are big donors that want to remain anonymous. I mean, Cuban's great, coming out strong for her. That was good. But even Bill Gates, I think, donated something like $50 million to campaign. And then he was pissed off that it actually got out. It's like they're supporting her. But when I look at it, it's people who are supporting Donald Trump and they're out there love him. They love him. They're like, this guy's going to save America. This guy's great, whatever. The people for Kamala, they're not really voting for her policy. They're just voting because they freaking hate Trump. That's a really big difference. So it is going to be interesting what happens. There's a lot of politics involved. There's a reason. There's only one reason why you let so many illegal aliens in, right? There's only one reason you would do that. There's only one reason why you wouldn't have people give you their license to vote, right? Which, is pretty easy and you need to show your license and everything. But, let's see what happens. It is going to come down to just a few states, other states, it really doesn't matter. It is tight. It is close, but I want to see if Polymark, I hope if Trump really wins by that percentage, it's going to open up the door to like this whole decentralization, blockchain, all the stuff that comes through there that can't be hacked. Because when you look at these polls, they've been wrong on both sides. If you look at the interim, we were supposed to see this massive red wave. We didn't see it. Then we were supposed to see this Trump get crushed, right, against Hillary, and that didn't happen. I mean, the polls are just so biased and so wrong that it's been crazy. But if you see what Polymarket is, and they're showing him very, very well ahead in all the swing states, really like 60 to like very, very, out far in front right now. Again, still 2 weeks to go. It'll be interesting, but it is influencing where money is going to stocks. And you're seeing that. And over the past 2-3 weeks, we've seen it, even in banking, it's going to be less regulation. Crypto's going higher and stuff like that. So you're just seeing some of the areas that make sense if Trump's going to win. Let's see what happens. 2 weeks from now, everything could change. But I'm curious to see if that Polymarket poll holds up. It's going to be a big deal because I think you can just forget about every other single poll because I'm sick of hearing them. I'm sick of them coming out. Everybody, just like I think there's 1,000 freaking polls, right? There must be 1,000 of them. Oh, this poll. I mean, if Fox is asking their audience, what do you think the poll is going to register, right? Republican. If you have CNN and MSNBC asking, what do you think is going to register? Democrat. So, some of these polls are just and how they conduct them and how I think people really don't want to say who they're voting for because you brought up a good example, Daniel.
Hell no, you get yelled at and
Look
labeled.
what happened to Jamie Dimon. Oh, no. I'm not. Like, he said good things. Like Trump wasn't a bad president, right? He said that at whatever the Davos.
Said he wasn't wrong about several.
He wasn't
things,
wrong about several things, right? And then right away he's a Trump supporter. He's like, no, I'm not a Trump supporter. Okay, now Trump supporter means you're. So and he's defending, and it feels like even if you're a public figure, a CEO, and you come out, you're gonna get wrecked because you cannot be in the middle. You have to have one or the other, and you really get wrecked. But anyway, let's see what happens. Again, we're going to construct the portfolios accordingly. I think we're well positioned. We're doing very well in a lot of portfolios. Market's still very, very close to all-time high. It is earnings season. But yeah, this election thing is going to get really ugly over the next 2 weeks, so definitely be prepared.
Learn to laugh at it. It's okay. Speaking of billionaires, so Paul Tudor Jones was on CNBC earlier this week, and this is a tough one. I wanted to ask you about this because everything he says is true, and you can't deny it. The problem is, and the great question is, when? So he was talking about how if Trump gets elected or whoever gets elected, we're going to have this reckoning and this bond revolt or something where yields surge. And obviously we want yields to go down to help consumers, help the economy, essentially like that. The Federal Reserve is cutting interest rates. Okay, we all know that. But what I respect about PTJ, Frank, as they refer to him sometimes. So he's a billionaire. So we give billionaires a different respect here. We listen to whatever they say because they're billionaires. And I like how he's calling this out. And he's saying, listen, we are broke. We are going to be broke. And we have these huge deficits. He points out the $1.8 trillion deficit the U.S. government ran October to October this last year. And for the first time, the interest on the debt surpassed everything but Social Security. So it's bigger than defense. It's bigger than Medicare. The only item is Social Security that's higher than the interest. He's correct, Frank, on saying about the debt and the deficits. I even think he's correct on the bond market going to really go against the Federal Reserve wishes. And we'll get to more of that as this conversation unfolds. To play Jeopardy here, the answer, Frank, is to be hedged. Gold, Bitcoin, commodities, which Mr. Jones says all that. The issue, Frank, is when is this going to happen? Because I know you like to rant about the gold bugs, and these guys have been right for, pick your timeline. They've been correct. Government spending is out of control. We can't do this forever. It's causing inflation. It hurts the little guy. All that's true. But, Frank, as they say, you ain't stopping this train. And outside of a global war where we lose, and I'm not being funny here, I don't know what causes this complete reset. And while you should be hedged, you just can't let this fear get in front of you and push you out of markets just yet. And I'll come back to that, but I wanted your take on that, Frank. What do you think of his call about the bond market revolt against the Fed?
I think that you're crazy listening to Paul Tudor Jones and Stanley.
What?
Druckenmiller. Yeah. Don't even listen to them. They have no idea what they're talking about.
Well, we can't talk about drunk Stanley yet.
Both of them, because we're seeing a lot of them come out. But I'm going to tell you something about Paul Tudor Jones, and obviously I'm joking because here's a guy that had, I'm not kidding here. So you're looking at 19% annual returns over 40 years. I mean, holy shit, right? So these guys, when they're putting their money in certain things or they say something, definitely listen. Of course, they're going to talk their book, and of course, they're going to be wrong time to time. We'll get into Druckenmiller as well because they both pretty much have the same take.
Yeah.
Where Druckenmiller's one of the greatest investors of all time. 4 decades of 30% average annual returns, right? So, which is insane, guys, really insane. I mean, the market's usually around 8%, 8.5%, dating back to like the 50s with dividends is S&P 500. So, these guys clearly, right, are ahead of the trends. The fact that they're both really shorting the bond market, I see a big sell-off in the bond market is telling. And what does it tell? It says that inflation is coming, that inflation is really going to start running higher again. And I have to say, when I'm looking at the data and seeing what's going on, Daniel, I mean, there's a lot of evidence to support this. Mm-hmm. I mean, what do we have? The Fed just cut rates by 50 basis points. When was it? I think it was September 16th. The 10-year is trading at 3.6. It's 4.2, pushing 4.3. That is a massive, that's like a stock going up 30, 35%.
Yeah.
And we're talking about a month ago, right? So while they're lowering, you never see that, right? Usually when the Fed's lowering short-term rates, you're going to see rates come down. It's telling you that inflation is starting to move higher. And when we look at the data and we look at the companies, all the companies that are reporting right now are saying that they're raising prices still, and we're still seeing it. Have you seen anything that's telling you that prices are going lower, which is insane because they're up, 25, 30% over a 4.5 year period, right? Across the board when you take a basket of goods, right? So it's up well over 20%. I don't know if it's at 30%, but it's massive, right? So now we have inflation. Okay, it's not going to, it's going to go back to 2%. It's still growing on top of that. You'd think it would come down where I'm like, okay, we're going to save every bill, everything that I'm paying for is much, much higher. And you're still seeing people pay them, which is crazy. So, also a good indicator is, showing inflation and a lot of these guys talked about deficits, right? What did you say, Daniel? Like, eventually going to happen or when it'll happen. I mean, look, it's hard because what I like to see in the market right now, and I'm going to give you my expert opinion, is I always love if I'm bullish on the market that I see a lot of bears coming out and pounding the table. I hate when everyone leans to one side, which we saw in 2022 before the market crashed. It's nice. But everything that the bears are citing are things we know and we see. We know the deficits are high. We know that they're through the roof. I mean, which is incredible, right? We're at 1.8 trillion, almost 10% higher than last year. No signs of spending slowing down. Everybody's saying that. These politicians don't give a shit because there's no repercussions. There's nothing, they're not going to be held accountable. There's nothing that happens to them. They don't have checks and balances like corporations do. If you don't, you got to cut employees. You got to make sure, you're getting profits and figure things out. With them, it's just like, it doesn't matter. This is taxpayers' money that's free to them. We're just going to keep handing it out to everybody. And Ackman also brought up a good point because if it wasn't for Joe Manchin, the Build Back Better bill would have got passed on top of the Inflation Reduction Act. And he was saying, inflation probably would have went to 20%, but they wanted to pass that thing as well, right? And you can go back to every president. This isn't me picking on the current administration. You go back, it's just, the Fed's like pushing Trump was pushing the Fed. You got to lower rates, right? When they started raising during his term. And what's Trump talking about is lowering taxes on tips, on this, on that. And it's like, okay, well, what we usually see, what's normal in regular markets is when the economy does well, that means the receipts are bigger that are coming in. That means usually deficits go lower. We're seeing deficits skyrocket at a time where the economy is doing good. You have economists, and I say it's doing good by the measures. I'm not saying that it's doing good by everybody out there. I know some people are struggling. I get it. I'm saying economists are raising GDP estimates. Okay, when we go into a recession, what the hell is going to happen? Now you don't see all those receipts coming in. So that's what they're seeing, and I get it. And look at look at what gold is telling us. Look what silver's telling us. Look what Bitcoin's telling us. Right, all those things running considerably higher. Right, gold at a record high. It looks like Bitcoin's going to pass through its record high, and silver's just surging. How do you argue against them? But I will say this: The bears are citing things that we all could see, that we all know. And what scares the shit out of me doing this for 30 years is the things you can't see. Okay, we saw that recently with Japan and the carry trade. Holy shit, what was that about? That's why the market came down a lot and it rebounded pretty quick. COVID, holy shit, you're really going to lock down the world? Nobody saw that coming. Okay, fine. The credit crisis, it wasn't subprime that caused that. People say, oh, subprime. That wasn't subprime. It was, they leveraged subprime 30-1, right? So, and they did it through entities that no one knew existed. I mean, even when shit was blowing up, you're looking at the Fed, you're looking at our government. They didn't even know that AIG was covering all this shit. They had no idea what was going on, right? And nobody really did. So, when you see things like that, you have to worry. It's the things that you can't see. And you're citing things that have been citing since the 70s with higher deficits. And it just keeps going higher and higher. But there's got to be a time where you're going to have to make it painful. It's got to be painful for investors. You're going to see a pullback. You're going to see higher interest rates. And I'm going to say this, Daniel. There's a zero chance of this happening. There has to be odds, because it's definitely not zero anymore, that the Fed could actually raise rates next year.
Zero chance it raises?
I bet you a month ago there was a zero chance. Now you're seeing inflation go up across the board in a lot of different areas, right? And they were like, okay, we'll cut by 50. How could they cut rates at their next meeting? What supports another cut?
Never mind. They're independent. You're right.
Yeah, but what supports the rate cut? How could they justify cutting rates? Just name a data point of them that justifies cutting rates. Because inflation, you're seeing it. It's starting to go back up. We're seeing it. They're getting lucky with oil coming down. That's fine. That's one thing. But man, you're seeing it across the board, even with companies. And when you look at what these guys are doing and how the 10-year, guys, this is something. When shit happens for the first time, you got to pay attention. Usually means it could be something broken something under the hood that we're not seeing. You don't see the 10-year surge like this while the Fed just, had, cutting by 50 basis points, which is very, very big for them right off the start. You don't see that happening. And you have to ask yourself why. And for me, I'm talking to people, I'm talking to great bond investors and trying to uncover this, but there is something going on. But underneath all that, what are we looking at? We're looking at interest rates, our short-term rates. The Fed is kind of in easing mode still, even though I just said I don't know how that could be, but they plan on easing. Earnings are very, very strong. They continue to hold up well. So, when you see those types of things, and do you really want to get in front of a train? Because I've been listening to these bears, especially come out over the last 8-9 months, and the market's up tremendously since then. So even if we get a 15% pullback from here, they're still wrong. So do you want to get in front of that train where momentum is good, you're seeing strong earnings? And we saw it. We'll talk about some of these companies, but from what I think here is you got to pay attention, you got to be cautious. It's very good that you're cautious, but also you got to be long, which we've been saying for a while now, because just you're looking at those factors that are driving the economy. People are spending, whether it's debt or whatever, and these earnings are being backed. These earnings are strong right now with the Fed that's saying, hey, we're still going to cut. Inflation will move higher, and I agree. I think that comes a little bit later, but right now you just don't want to get in front of a freight train, and that's why our portfolios are doing so good, because we're positioned well. But we are very, very cautious because there's things that are happening that never really happen, and that's when, the little radar needs to go up.
Yeah, quickly, what worries me is that you have a Fed that is anti-recession. And so they have this mindset, and they have great power. They are unchecked. They print money out of air, just thin air. And here's what's crazy is that if interest rates continue to rise like they are, and let's say the 10-year or the 2-year gets to 4.5% or close to 5%, what scares me is that the Fed is not going to allow any pain to happen for any length of time. That's their new goal. And this really happened Greenspan started it, Bernanke really took it, and Fed Chair Powell is running with the torch like he's in a freaking Olympic race. And what's going on here is that you'll see the market sell off, equities pull back, and then Wall Street and everybody will clamor and raise and scream and say, well, what is the Fed going to do? How are they going to save us? And they can do yield curve control. They can do all kinds of things. And that's what's nerve-wracking. And that's why you can't just sit on the sidelines. So yes, be hedged, commodities. One thing I wanted to ask you, Frank, is I liked how, Stanley is supposedly, Druckenmiller is supposedly short the long bond from what I've read in a couple articles. I don't know the details. I've seen 15 to 20% of his portfolio. He's betting against the longer bond. So he's expecting rates to go higher, with inflation to go higher. So is Paul Tudor Jones. What I liked is Paul Tudor Jones just said, hey, I don't have any fixed income exposure. I'm not messing with it. And Stanley's going after, and he's going to go short it. I'm not that smart, but I would play that somewhere in the middle. I don't know why you'd lock up interest rates for any length of time when you can get short-term treasuries paying good percentages. And then you can look at dividend stocks and you can just be hedged. I really think that's how to play it. But the thing that needs to keep you on the sidelines is that this mentality is that when stuff hits the fan and people start panicking, they just look to the government, and for a while that's going to work. And that doesn't work, or that doesn't change under either candidate, because they're all just, hey, we got your back. We can guide everything. We can control everything. We're big, powerful. And that's not going to work long term, but it's sure as hell working right now.
Yeah. And one thing I'm going to disagree with you on is when the Fed could control everything is always there, and they prevented recessions, bailouts, and stuff like that. It's very easy for the Fed to do that in a non-inflationary environment, right? Because the tools in the tool chest really, everything that they're going to do in bailouts, it's basically printing money, lowering rates, right? These are the tools to stimulate the economy when things are going shitty. But now when you have inflation coming back into the market, we can get into that right now, but just, what higher rates do? I mean, look at the housing market. The 10-year rising. Now you're looking at mortgage rates starting to surge. Okay, the 30-year fix is, over 7% again, which is crazy because you still have home prices are rising.
Yep.
They're rising up 3% year over year, and that's a 15 consecutive monthly increase, right? And when this is happening, what else do you have? You have inflation where all the costs are outside of your mortgage surrounding your house. Insurance is surging. You're going to buy furniture for you, electricity, property taxes, cable, streaming bills. Everything continues to move higher to the point. And I'm going to give a shout out to Charlie Biolo here, who's really good. If you follow him on Twitter, he just provides really good stats on the market and stuff. The median household income necessary to purchase a medium home right now in the U.S. is $120,000. That's 40% higher than the current median household income of $85,000. So you're being priced out of buying houses. And by far the most unaffordable housing market in history. And I actually...
Yeah, tell me about it, Frank.
Holy shit. It's, and I have a picture of this too, if you're watching on a YouTube channel. I mean, all you have to do is look at this freaking gap. Holy cow. I mean, it's insane. Like, we haven't seen anything. And I think this chart goes back probably to 2000 maybe. And it's incredible. It's just, how do you, with rates going higher, again, we've set up the CPI. The government set up the CPI so it could never show inflation, right? And it's always going to show low inflation. That's why they have real estate in such a big component, especially rental income, because usually rental income doesn't skyrocket like it happened to do out of nowhere. And that's really what causes inflation going at 7, 8, 9%. We've always known that we had inflation in the markets. We've all seen it through our bills, but they're always like, hey, it's at 2%, it's at 1.9%, it's 2.3%. Our costs would continue going much higher than that. But now, with inflation out there, could the Fed actually come in and do something about this? Could they bail out everyone? Because it's going to result in more inflation, right? So, which is scary. So, they always have tools in the shed. Believe me, they can go, things that they could do. But you're running out of the security blanket and that Fed put that you always had. I just don't see how they could lower rates going into the next meeting. Like, I don't know what evidence is going to be present for them, because you're seeing inflation across the board move higher. And that is evident just by the earnings that came out. And I want to talk about just a few of these, because we cover really in detail on tomorrow's podcast, which is a Wall Street Unplugged premium podcast. We could start with Starbucks. I mean, did you see Starbucks? Starbucks was down 10% after they reported, and now it's flat.
That's more telling than anything else. But the new CEO came out and just lowered the bar, right? He's saying, "Hey, this
lower the bar.
This is my game now."
He basically said, "This company I went to was a big mistake, and I really fucked up." Under his breath, that's what he said. He goes, "What the hell was I thinking? What the hell was I thinking going to this company?" He's going to get paid a lot of money, but the credibility part's going to be tough. So here's what Starbucks said. It's the fact that the stock is flat. This is an uninvestable company right now. It's uninvestable at this price. You can't go near it. Don't go near it. Okay. Same store sales fell. Usually you see any company, same store sales, you see 3%, 2%, up, down, 5%. They fell 7%. Third consecutive quarterly drop in same store sales. Listen to this.
Not good.
Lowered their estimates for next quarter, which they're coming out. This is Q4. They're coming out on the 30th. They also removed their guidance for 2025. So they told all the analysts, we have no idea what's going on. We have no idea what's going on, right? Weakness everywhere. 6% decline in the U.S., driven by 10% decline in transactions. China's same-store sales declined 14%. Those of you who think China is coming back and everything's good, again, we're not hearing that from any company yet. This was in the face. What did Starbucks do? Starbucks raised their prices by 4%, and they still reported this garbage. Now, when you look at the CEO, Brian Niccol, right, who's superstar, he actually came out and said, we're losing the occasional customer as demand for our products are falling. And he said the company needs to fundamentally change our strategy so we can get back to growth. Do you know how hard it is to fundamentally change a strategy for a company that big that's losing its customers? And by the way, I've probably been to 3 Starbucks in the past 2-3 weeks. Every one of them was a terrible experience still. I couldn't wait on the drive-thru because there was too many cars because they were too slow. I went inside, I had to wait 15 minutes, right? And I'm talking about getting like, not even like coffees. I got these lemonades, one for my daughter and myself with a couple pastries, right? And we were there for like 20 minutes. Every one of them, every single place was a disaster still. And I don't know if it's because it's very hard to make those drinks, so you need specialized employees and it's tough to get employment. It's a broken model where you lost customers. When you lose customers like that, it's so hard to get those customers back, especially since you talk about coffee lovers, which is a drug. They go to another place and they find another place and they settle. And now, do they want to come back? No, now they're used to their new place. So yeah, when I'm looking at this company, the stock was down 10%. Again, it's flat now. It came back, which is insane. I never seen that happen in my life as an investor, no matter how low expectations are, when a company for the first time removed their full year guidance and did not see a significant pullback in the stock. So when I look at it now and where this name was, look, it's $96 right now. It was $75 before Niccol came on, right? It was getting beaten. Okay, back then it was trading about 19, 20 times forward earnings. It's trading at 26 times forward earnings at a company that's declining. Same store says every aspect of their business is down. They're raising prices in the face of customers that are pissed off at them because they just don't like the experience anymore. So what do? They're like Disney. Hey, let me raise my prices. That's why Disney stock is a dog shit, which we've been saying when everyone was pumping the shit out of it at 160, 70, and 180. We told you, right? And told you about Disney in terms of streaming, how they couldn't compete. Their new content does not come out on streaming first. It comes out in the theaters first, and they have to raise prices significantly, and their service is inferior to almost everything out there, right? It's not about the library. It's about new content. They don't have a lot of new content because all that great new content comes out in movies first. Starbucks is a very broken company, trading at 26 times earnings. This stock should be trading at 20 times earnings. I would say it's 75. I probably wouldn't buy it. But this is a name. I was surprised that they got away with raising prices and still reported these results while raising prices. On the flip side of that, if you look at Coca-Cola beat their earnings, beat their estimates. That's what you see. That's the headlines. The reason why I listen to this podcast is because Dan and I like really looking into the numbers. Beat both on bottom and top line, which means the top line is sales, the bottom line is earnings. It wasn't driven by demand. Case volume was down 1% in North America. Globally, it was down 3%. Across the board, sports drinks, coffee, tea products, even energy drinks were weak. That's supposed to be a big growth market, right? Which is also confirmed by Pepsi in energy drinks. Bottled water globally for them, down 6%. I mean, it's because the bottles don't stand up anymore because they're eco-friendly. And even when you grab them, the whatever you want to call it, it's not the wrapper, but it just falls off, right? It's like the label around it just falls. I mean, what they did to those, maybe that's it. But you're looking at it, you're saying, how did they beat? They beat because they raised prices, right? Inflationary environment. I thought this was done. They raised prices. They had to raise them significantly because volumes were down. And if you're looking at it as an investor, you see it because if you're going and say you're a Coca-Cola fan, you're looking at a Coca-Cola, a case of Coca-Cola is like $9. Okay, it used to be $7 like a year ago. Hey, buy soda at a restaurant. Daniel, what's your favorite soda?
Crazy.
Right?
Diet Coke.
Diet Coke fountain, right? What do? You go to a gas station. How much do they charge at the gas station?
It's $1. Well, it's 75 cents for a refill, and it's $1.27 for a medium at the gas
it's
station.
Minimum $3 at every restaurant.
Oh yeah, so
minimum
it's coffee.
$3 and $4 at restaurants. And I don't even get soda or anything. It's $3 to $4, right? And it's which is crazy. So Coke's like, hey, if they charge us $4, we could raise our prices, right? So when I see these companies and they're raising prices, and every company I feel like is coming out is raising prices, it's crazy. And Coke is the same thing, right? So they're raising prices. They're not seeing volumes go higher. You know, same with Starbucks. You're not seeing like this brilliant quarter or anything. But for them to remove guidance, and I don't know what they were thinking. I have no idea what they were thinking. I mean, I don't even want to put an analogy on it because I'm probably going to insult somebody, but why would you raise your dividend? I mean, what does that do? Like, are you really going to buy a company? I mean, good luck. I don't even know what their dividend is. Go get it, because whatever it is, subtract 15% returns from that, and that's going to be your returns over the next year. Why would you raise your, like, right now, spend on finding great talent out there that's underneath you that you're going to need at a company that big. I mean, spend money on different initiatives. Like, nobody's buying Starbucks for a dividend right now because it's super crazy expensive. You never want to buy dividend stock of a company that's seeing declining sales, declining earnings, everything. And they removed their guidance, which means they could be down 20, 30% next year. You have no idea. And from a Wall Street perspective, an analyst, they hate that because their job is at risk, right? That's why you see all these with target prices and their models. When you hear the conference call, they're all asking about, what about cost of goods? And little things that they could update their model with. And when you don't give that to them, they're forced to guess. And what are they going to guess? They're going to guess the worst right now. And that's not priced in because the stock is trading, 20% higher than when the CEO came on board. And that was a month ago, a little over a month ago. So none of this is his problems. But for those that think this is going to be fixed like within 3 to 6 months, you're out of your mind. I mean, it's going to take a long time, and man, it's going to be painful. This guy's going to be working 3 times harder, 4 times more hours than he worked at Chipotle, which was pretty much a business chugging along and doing well. Again, I don't know what his compensation package is, but I'm sure under his breath, he's like, maybe you should have took a better look at what was going on before going there, because it's not going to be pretty. It's going to be really, I feel like it's Iger going back to the company going, I have to come back for this shit. Yeah. I got to cut everybody. I got to fire everybody. I got to cut costs completely and get out of the leftist mindset that the company's like, it's nice to go into a company and fine, you try to build it up, or you have a CEO retiring. But, coming into that company right now, man, good luck, because he's got his work cut out for him. And I know he's good and he'll probably manage it, but it's not going to be anytime soon.
Speaking of earnings, I want to get to GM, but quickly here, Frank, this is a stock that I've glanced at here and there. I've been on this kick where I screen for different components of stocks, cash flow, cash, whatever. But then I also look at the price, because what drives me crazy is looking across the media, Fox Business, CNBC, Yahoo Finance, and all that. Essentially, when you watch these programs, and listen, I get it, they have a job to do. We all have to fill a 24-hour news media cycle. But you don't hear a lot about the higher price stocks. And I don't mean valuation. I mean like $200, $300, $400, $500, because individual investors don't care for them. So I pay attention to some more of these because these are great leaders. Packaging Corporation of America reported strong earnings, Frank. The stock is up about 5% right now. They're the 3rd largest producer of container board. So just think of the boring shit you ship everything in, okay? Mm-hmm. They have 7 mills and then 86 converting operations. But if you look at the stats on this, it's trading at about 19 times forward earnings, in line with the market. Next year, from 2024 to 2025, they're supposed to grow earnings 24%. And then I don't want to get crazy and look too far out, but then another 12% in 2026. So if you have a company trading at a market valuation that doesn't get a lot of press and is also growing much faster than the overall market, that should get your attention. I want to dig further into this, because what is driving this? Well, obviously you have the big boys and all this container board is used in the shipping, which is not showing any signs of slowing down. And if you have a sluggish or growing economy, that's good for this type of stuff. And as Frank's talked about earlier, with interest rates and different things, you're going to see these cycles. So we've seen housing and stuff like that. Dreamfinders Homes, that I'm a huge fan of, based out of Jacksonville here, they've pulled back with rates going higher. Shouldn't surprise anybody, but can still set up for a trade. But Packaging Corp of America is a great find in what I would think is a stagflation economy. So if shipping really falls off the hills, then hey, you got bigger problems. This is just a good monitor on the overall economy. And from glancing at it, I'm telling you, in a down market like today, Frank, the market's down 3 days in a row. Pack your bags and let's go do something else, because the world is coming to an end. 3 days in a row, for crying out loud. But they're putting up a good day, up 5%. They were the last time I looked. So check out.
Before you get the GM, I want to mention, because quick educational part here is when Daniel says that market multiple, a market multiple means what the S&P 500 is trading at. So when we say the S&P is trading at 21 times forward earnings, that's collectively the average multiple of all the S&P 500 companies, right? So when you say if it's trading at a premium to that, which Starbucks is, which we talked about, it means that Starbucks should be growing earnings faster than the overall market, which is what, Daniel? About 10% right now are the projections, maybe 10, double digits, I think 10, 11% growth this, next 12 months. And I think sales growth is like 6%. So if you're growing sales and earnings higher than that, you should command a premium, a higher multiple, maybe 23, 25. That's why you see technology companies, it's all about growth. When you're growing, you're going to get a higher multiple. It's going to be more expensive, but you have more potential for growth. And when you see companies like Starbucks that we were talking about, Starbucks is seeing growth slow down dramatically and they're trading at a premium. That's when you have to worry. And what you were saying about Patch Corp America, which is trading pretty much at a market multiple, they're growing their earnings and sales much, much faster, which is something you want to look at. And a lot of people will be turned off by that stock. Why? Because when you see the price is $228, how am I going to make money on $220? Guys, if 10% is 10%. If you buy a stock at $1 and it goes $1.10, it's 10%. If you buy this stock, $228, it goes up $28. 10% is 10%, because if you look at every company that crossed 100 and see where it is right now, 2, 3, 4, 500 that you didn't want to buy, don't look at the price. You're going to buy less shares, but you could put the same amount of money into it. Right? So if you're buying 10 shares, you're buying 50 shares, whatever, it's a $5,000 investment. Doesn't matter if it's going into $1. So many people believe, oh, wow, I can generate so much more money than this. If I put in $1, it can go to 10, 20, 30. Usually if it's trading at $1, it's a piece of shit company. That's why it's trading at $1, guys. And trust me, I've been there. I've been doing this for 30 years and I made those mistakes. It's not like I'm some kind of genius. But Patch Corp America at $230 and all-time high here looks like a steal, because the valuation is still very, very cheap. It's trading at a market multiple when it's growing much faster than the overall market. So, and
to your point, it's just money is psychological. People, including me, you'd rather buy more shares than less. But put that aside, understand that that's an emotional part of money, and don't let it influence your decisions. Because like you said, if you put $10,000 into something and you make 50%, it doesn't matter how many shares you have. You still made 50% on 10,000.
Yes. So GM.
All right, GM.
Go get them.
Go listen to that.
Go get him, baby.
Yeah. GM, listen, I'm in Frank's camp. I'm not a big fan of these autos. I don't want to put words in Frank's mouth, but looking at GM, it rallied to a 52-week high yesterday, was up 9% on what I think is very strong earnings. I have one caveat, but when you look at these earnings, let me pull this up here. Revenue jumped 10%. That's pretty damn good. Sequentially, it jumped. That was pretty good. And the headline that everybody likes to talk about is, for the first time, ICE, internal combustion engines, Frank, did not outpace EVs.
EVs outpaced. They sold more EVs than gas cars.
That's right. Now,
which everyone thinks the EV trend's over. I told you, it's all about pricing. I mean, I bought an EV, and I'm totally against it. A lot of people are saying that look at his diet. Like, so many people, they just think, even with the Apple Watch, when the estimates were crazy in the first 3 years and it came down, it builds up over time. Sometimes you're too quick, and pricing solves everything. Where I would have never ever bought an EV, and I bought one for my daughter because it was dirt cheap. It was cheaper than the gas vehicles I was looking for her. So yeah,
and they are doing some pricing now, and they price them accordingly so that the customers can get this $7,500 credit from the Inflation Reduction Act or whatever BS program from the government there. Here's the caveat, though. So they're still losing money on EVs, even though they're ramping up production and sales. So you got to give them credit, because just because they're losing money now doesn't mean they're going to lose money forever. From what I can tell, they lost about $800 million. They talk about this $2 billion to $4 billion increase or betterment. So they're not going to make $2 or $4 billion. They're going to lose $2 to $4 billion less next year on EVs. And they even said this, I don't have it in front of me, I apologize, but they said something about variable profitability, which means they're not going to be profitable quarter after quarter after quarter. It's going to be very lumpy. Now, they're doing a lot of things, and you can argue, hey, they have a lot of levers to pull. Frank, do you know how many shares they're buying back?
That was one of the things that I said. Like, one of the things with GM and buying back their stock, their buyback is massive, massive. And here, pay attention to this segment. But again, it's what? So more than 10%, right?
They reported third quarter earnings. Mm-hmm. So year over year, from last third quarter to this third quarter, they bought back 19% of the shares outstanding of the company. During this quarter, this recent quarter that they reported just yesterday, they bought back $1 billion. They have roughly 1.12 billion shares outstanding. They want to get that to 1 billion, so they want to wipe out another 120 million-ish by the early 2025. We're in the last quarter. So they're going to have to spend a lot more than $1 billion in the next quarter or quarter and a half to get to that share count reduction. And Frank, the beautiful thing here, unless you bomb, who is it that bombed? The five below or five
Yeah, a lot
Who was
of those.
that retail company that we had fun with when they
I think it
bought
was
back a ton of their shares,
Five Below, I
reported
think,
terrible earnings, and then the
or
shares
Dave and
collapsed.
Buster's, one of those.
Somebody.
Yeah.
Okay, so there is
Yeah,
a good and
either
bad
one.
way to buy back shares. The blessing here that GM has is that you don't know if they're wrong for the future. So buying back all these shares right now, well, it looks great because the stock's at a 52-week high. We'll see how this unfolds, how the economy, but I'm not a fan of GM. I still wouldn't touch this company. If you're in it, congratulations, you're making some money. And like I said, it's at a 52-week high. I'm not sold on this because of all the levers they have to play with and pull to get these solid numbers. Plus, China's still a mess. I'm not a believer in EVs, but that doesn't mean they can't be successful. But again, this is a buyback story, not just a earnings growth story.
Listen, I was saying avoid these stocks, avoid GM. Mentioned the buyback's really good for it. Wouldn't short it. Ford's different. Ford is 30% off its highs. This company, looking at the numbers, look, this is a company I wasn't crazy about. They blew it out. I mean, I was looking for holes, and there wasn't a lot. And you know, driven by what? Higher prices, still raising prices. Every company, listen to that theme during earnings season, because that's going to show up inflation when? In the next couple of months in inflation reports, right? So, you know, while past inflation report, hey, Frank, we're not showing, remember, it's a lagging indicator. But if every company's telling us that they're raising prices, we're hearing that. I mean, 3 of the major companies that we just covered today, we're not cherry picking. Those are 3 companies we were looking at. Every one that we looked at today, we're going to really dig into details tomorrow and have a new recommendation or whatever. But every one of them, it seems, it doesn't seem, they're all raising prices. Inventory was down. They sold a lot of inventory, down 50% since the start of the year. That was one of the biggest concerns I said with inventory. How are they going to get off the books? We're seeing it with what is it? Stellantis, which is horrible. We're seeing it Ford, which is bad. We're seeing with a lot of dealerships. I mean, holy cow. Revenue, like you said, growing 10%. And then, the huge buyback, what does it do? It puts a floor under the stock. Now, big buybacks when your stock is expensive, you got to be careful. You don't want companies buying back. I think Snowflake did that. A couple of other companies we highlighted. We hate that. When you're looking at a company with this big of a buyback, when it's more than 7% of the float, and GM is more than that, buyback is great. It's much better. There's charts out there. There's figures. I've done tons of research on this, guys. It's much better for a company to buy back their stock than issue a dividend. Much, much better. Okay, the numbers support that. These are companies, because if you're buying back stock, what are you doing? It means that you're generating a shitload of cash flow. It means things are really, really good at your business, right? You have no place else to put the cash, and you're lowering that float, which that's all you care about, right? You could argue the politics about it and money about it, and the money they save this, through tax receipts or whatever, and with Trump lowered taxes, and that's what they used it for, and buyback, whatever it is. Your job is to make money on stocks. I could tell you one thing: for those who are citing that the market's going to crash, while we're seeing very, very strong momentum here, we're seeing a Fed that's fixed on lowering rates, where we're seeing earnings very, very strong. Buybacks. Right now, U.S. companies are planning to buy back. You want to guess this number over the next 12 months, Daniel?
No.
$1.1 trillion. $1.1 trillion. That's a record. Last year, it was $943 billion. It's a huge catalyst for many of these stocks. Be sure, if you're going to short a stock, which I know a lot of you don't do, and I wouldn't suggest it because Ackman gave up on it, and you have Chanos giving up on it, and it's just very, very difficult, because all you need is a little bit of a short squeeze, and you could be right on a long-term thesis, but if you're wrong right away, you're going to be sleeping on a park bench. I mean, it's a game, especially with a Fed that's fixed on always propping up the market. It's very difficult to short. Maybe you just say you avoid, or maybe you use ETFs or something like that where you don't get annihilated. But make sure you look if that company has a big buyback in place, because what's going to happen if that stock gets hit on earnings? It's probably going to go down, but what's going to happen? They're going to turn around and they're going to buy back their stock, right? And that's why I think, instead of raising a dividend at Starbucks, if you think your stock has that much value, forget the dividend. I mean, buying that stock based on them raising the dividend is crazy. Maybe they think it's cheap. Obviously, they don't, because they remove guidance. But I'd rather keep the cash on the balance sheet. But for me, when I look at companies, it's much, much better to buy back your stock than to increase your dividend. And I know a lot of companies have to do it because they're on the dividend aristocrat list, and we've been doing this 25 years on every single year. I don't give a shit about that. I don't care, because what they're doing is just checking off a box. What's the best value for your money? What's going to benefit the shareholders? And benefiting the shareholders, these buybacks, you see time and time again, it's no surprise. When you look at the companies that are buying back their stock, they outperform the overall market by a mile. I provide statistics like that up to, I think, a year and a half ago, and it's even greater now. But pay attention to those buybacks. That's a huge, huge catalyst. 1.1 trillion is a lot of money. So if you're thinking the market's going to pull back, what do you think a lot of these companies are going to do? They're going to be buying back their stock at cheaper prices, and it kind of puts a floor underneath them. So definitely pay attention to that. Think we covered everything? Covered a lot today. It was a good podcast, right?
Yes, sir.
Just through everything. I like to hear the political debates. We always get, some emails on that, which is kind of funny, which is cool, again, which is really cool. But again, it's about your portfolio and how you're going to construct it. And obviously, with Polymarket, and you're seeing Trump, you're seeing the sectors that he supports through his campaign and plan. You're seeing those sectors actually do very, very well, especially over the past 2 weeks, which means what? If Harris happens to win, you're going to see that unwind. So something to pay attention to.
Tomorrow I'll get into my conspiracy tinfoil hat wearing idea.
You have a conspiracy theory? No way.
I'm going to tell you if the market crashes.
No way. No, I can't believe that. Anyway, we'll end with this, guys. Listen, thank you so much for everyone that came in. We raised money. We raised money because we're growing, and company is it's a lot of fun here now. Great team. We cut costs about 12 months ago, and not only have we cut costs, our sales have gone higher, which is great, especially for the first 4 months of the year, our last reporting date. And now we're seeing traffic across our platforms. We're able to use AI, which is working for us. Dan and I are going to cover that tomorrow on podcast, how companies say they're using AI and they're actually benefiting from AI. It's a huge, huge difference because now you're seeing separation in those companies. The ones that aren't benefiting from AI that said they were, they got that premium and are getting nailed. And the ones that are benefiting, you're seeing those companies really stay at these valuations and even go higher after earnings. But we offered a convertible into our token, which represents an equity stake in our company that pays a 10% cash dividend annually. It's a really, really good deal. Happy for everyone that came in. And I'm just saying that it's going to close. So we're going to close in 2 weeks. If you're interested, you have to be a credit investor. It's a $25,000 minimum. Again, you get to talk to me. We send you a link. We talk about it in a whole video that you can watch everything. And then a lot of people have follow-up questions. You can arrange a call directly with me. I would say about easily over 90% of the people that call me invested in a deal, and I'm not selling you the deal. I'm saying, hey, these are the facts. If they're like, well, I don't want to come in, that's it. There's no follow-up. Oh, well, but did you? No, nothing. It's a very good deal for investors because if I get this right, and I feel like if we get this right, and we have a lot of momentum right now, and our consulting business that we just launched is already signing clients and doing great, which we're really excited about. It gives you a chance to really have gains that you can't really get in a lot of companies these days and IPOs because you can't really invest in the ground floor, right? These companies come out of IPOs that come out at such high valuations where this, if we really get it right and we turn this into a $20 million, $30, $40 million revenue generator, which for the first time since I started this company, I see that. I really do. And it's exciting. Again, if I walk out of this building right now and get hit by a tree, that's different, right? There's a lot of risk there. You could lose your whole investment, and we have great people here and stuff like that. But we have a person's name on a door, and again, it's a big deal. And every company who's an entrepreneur who started, which are big companies, that's the case with all of them. We highlight all the risks, right? But for this deal and being invested in lots of deals where I made most of my wealth in investing in companies in early stages and being a credit investor, this is one of the best deals that you'll see. And that money is going 100% to growth. It's not going to raise salaries. It's not going to pay bills, shore up a balance sheet. It is going to growth because, for the first time, we're seeing almost everything that we're doing really growing fast right now. So if you're interested in getting into that deal, let me know because we're closing in about 10 days from now. And again, the response has been unbelievable. I talked to so many amazing investors. I just went to lunch with one yesterday who already invested, and just brilliant, brilliant people and great people, which is really, really cool. And I appreciate all that support. So if you're interested, reach out to me, frankcurzioresearch.com. I can send you the details. If not, no worries. It's just for our file and people that follow me the most. And again, it gives you a chance to really get in a company on the ground floor if we get this right. There are risks there, but it's something that I want to offer and I want all my investors to participate in because, things are really good right now. So really, really excited. We'll end with that. Daniel, any parting thoughts?
No.
You always say no. I don't know why I ask you that.
See you tomorrow.
It's so hard. When you're doing an interview, it's like doing an interview. You ask a guy a question and he goes, no.
No. I
Yes.
don't want to talk about that.
Okay. He's not giving you anything.
Next.
Right? No, nothing. But anyway, we'll have a lot to talk about tomorrow, guys, on Wall Street Unplugged Premiums. Definitely join us then, and see you tomorrow. Take care. Love this episode of Wall Street Unplugged? I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. Well, I'll do even more than tell you what's moving these markets. I'll tell you specifically what moves you can make today. So this is going to be about trading. Put big money in your pocket right away due to the inconsistencies I see daily in the market. I'm talking about specific investment ideas I'm recommending and tracking each week that I believe will be impacted directly by everything I just talked about today. Plus, you're going to get the chance to go even further down the rabbit hole with me and my co-host, who's Daniel Creech, as we discuss which of these week's trends could turn into massive windfalls. Including the big trends that we see lurking on the horizon, also the news we're picking up from our network of insiders, which has gotten bigger and bigger thanks to you and so many people listening to this podcast in over 100 countries. And you get a chance to talk to me directly in my special Ask Me Anything Q&A session. All of that and a lot more, like premium interviews with world leaders in finance, technology, industry, and politics. This is all part of Wall Street Unplugged Premium. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today and you won't miss a thing. That's WSUoffer.com.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.